Good afternoon from London. You are here for this afternoon's FS Club webinar entitled Climate Change and the Financial Services Sector Supporting the Net Zero Transition. My name is Simon Mills. I'm Senior Researcher at Zien, and in a minute I'm going to guide you through this afternoon's proceedings and introduce you to our guest speakers. Three of them today: Hector Fontaine, Joe Lovett and Hannah Peter, all from BCS Consulting. But before we begin, I would just like to offer a word of thanks to our sponsors who not only give us a wide-ranging brief for these webinars to wander through the halls of politics, economics, science and history, but also allow us to open them to the public. If you'd like to know more about FS Club, do drop us a line. Now, the format for today's webinar, as always, is very straightforward. You're going to be shot of me in a minute and hear from today's speakers, following which there will be time to explore some of the issues that they will raise in more depth. This webinar is going to be recorded and you can revisit it or any of our previous webinars on our website. If you've got any questions you would like to put to our speakers, please use the conversation tool on the right-hand side of the screen. I'm going to consolidate your questions and I'm going to put them to our speakers at the end of their talk. And so to the first of today's speakers, Hector Fontaine, the Sustainable Finance Lead for BCS Consulting. Hector, tell us, how can financial services support the fight against climate change?
Good afternoon, everybody. Welcome to this webinar. It's a pleasure to be here to discuss the climate change in the financial sector and supporting the net zero transition. I'll start this presentation and then I'll hand over to Hannah, who will then introduce herself, as well as my colleague, Joe Lovett. Just briefly about me, as Simon said, I lead sustainable finance for BCS, and we do a lot of work in financial services, advising banks and asset managers in climate risk management and broader climate management, including the transition to net zero. So let's quickly move to the next slide. And yeah, you can see there are profiles, but I think I've already introduced my profile, and I think Hannah will do the same when we get to her slides, and Joe, so we can move to the next slide. Let's quickly run through the agenda for today. So we'll start by discussing why climate change matters in the financial sector, what are some of the key risks and opportunities. Then we'll move on to talk about the regulatory landscape for the financial sector and some of the key industry initiatives. And then we'll deep dive into the road to net zero and some of the interesting things we're seeing in the sector to support the transition to net zero. And we'll finish with some analysis of climate disclosures and the progress that has been made in relation to climate disclosures, particularly in the banking sector, where our firm BCS Consulting has been doing quite a bit of research. And of course, we'll have plenty of time for Q&A at the end as well. So let's start with why climate change matters in the financial sector. Clearly, climate change isn't a new thing. It's been around as a concern for decades, but we've certainly seen a lot more momentum in recent years. There's more acknowledgement that there is an emergency, that there is more to be done urgently to prevent the most devastating effects of climate change. And certainly that concern has triggered more activity in the financial sector specifically as well, primarily driven by at least three key factors. First, there's more social pressure from wider stakeholders expecting financial institutions to assess the environmental impact of financial services on the wider economy and to truly engage in global environmental initiatives. If we think of the UK, we've seen examples such as the Extinction Rebellion targeting the City of London and the big banks and their financing of carbon-intensive activity, particularly oil and gas. We've also seen plenty of NGOs highlighting the role of the financial sector in financing environmentally impactful activity. So there's clearly a lot more awareness that the financial sector has a very important role to play, and it needs to be an active player in the transition to a low carbon economy. But in addition to the social pressure, there is also increased regulatory and shareholder pressure to ensure that financial institutions are factoring the impact of climate risk in their own business models. In the next few slides, we'll discuss the regulatory agenda and some of the numerous initiatives within the UK and Europe in particular. But thinking of shareholder pressure, it's interesting to see that shareholder annual resolutions are starting to consider climate very actively, which wasn't really something very popular 5 or 10 years ago. For example, in recent months, we saw HSBC table a resolution committing to phase out financing of coal-fired power and thermal coal mining by 2030 that was approved. There was another shareholder resolution in the Barclays annual general meeting that was not approved, but nevertheless had significant shareholder support to ensure that the bank had more aggressive climate risk targets. So it's clearly becoming a concern of shareholders from a business point of view, climate, and it's ultimately translating in more discussion, more debate at the board level. If we think of the asset management sector, BlackRock, for example, has been setting shareholder resolutions and voting against management in multiple companies. More than 50 companies in the energy sector, they voted against resolutions, against management resolutions, because they felt that management had not achieved sufficient progress in the climate agenda. We've seen Legal and General actively putting pressure on oil firms, etc. So there's clearly a lot more shareholder pressure also driving action. And last but not least, there are new financial prospects. So clearly the development of environmental, social, and governance products to support the transition to a lower carbon economy and the wider sustainable development and global agenda is also triggering a lot of momentum in the financial sector. And sustainable finance has emerged as a term to refer to the integration of environmental, social, and governance considerations within the financial sector for the lasting benefit of clients and society. So moving on to the next slide. Here we discuss how climate change is a new source of risk. Now, climate has clearly two key drivers of risk. On the one hand, we have the physical risk, which are relating to the increasing severity and frequency of climate-related hazardous events, such as precipitation, high heat stress, droughts, hurricanes, etc. And that is perhaps the most well-known or most intuitive type of risk in relation to climate change. But there's also the transition risk, the adjustments towards our low carbon economy, which will require significant structural changes. For example, a new environmental policy, new regulatory requirements, technology shifts, changes in consumer behavior. And we're starting to see that already in the world. I mean, a good example of this is electric cars, which are gradually but surely gaining more market share in the car industry. They now have about 4% of the global market, and just a year ago, I think they had 2.5, which doesn't seem like a lot, but it's a very rapid growth, which means, for example, that if you're a company in the car industry and you're not producing electric cars and you're not in a good position to produce them, you might be more at risk from a business perspective than a company that does have the capability. So those are some examples of the transition risk, which can have a knock-on effect on multiple industries. And of course, these physical risks and transition risk translate into very tangible changes in the risk profile of traditional risk types within the financial sector. So if we think of investment risk, changes in the prices of equities, corporate bonds, and other assets might be triggered as a result of climate change. You might have also a different operational risk profile as a result of climate risk. Perhaps your business is more vulnerable to hazardous events, and you might have more business continuity issues. Or you might have more credit risk because some of the borrowers might be more exposed to default because their business model is less competitive in the future than it was in the past. Or you might have liquidity risk, so funding challenges as a result of financial stress, or perhaps liability risk, increased compensation demands for climate-related losses. And of course, this last one is a key concern for the insurance sector. The bottom line is that climate risk has quickly become a driver of traditional risk types across the operating model, and risk managers, of course, need to be looking very closely at climate and how it might impact traditional risk types within their organizations. Moving on to the next slide. In addition to the risk concern, there are also many opportunities in the financial sector for climate change. Clearly, there is a growing demand for ESG products. Trillions of dollars of capital are required to build a sustainable infrastructure. And of course, the financial sector is a key source of capital. And they can pull capital away from activities that do environmental harm, and they can channel capital towards activities that support the low carbon economy. And we're starting to see increasing demand for ESG related products and for climate solutions from the financial sector. This is still a non-saturated market. So if you look at trends year on year, there's significant growth. It's not yet plateauing. We're also seeing a new source of returns for asset managers, for banks, and other players in the financial sector. So here, companies that have particular skills, that have deep expertise in sectors, will be best placed to advise corporations in how to transition to the low carbon economy. When we think of banks, when we think of asset managers, unique skills and capabilities to assess the environmental impact of corporations will give them a prime position to build ESG portfolios and to get momentum in that space. So this is clearly a really interesting area from the opportunities point of view for the sector as well. Moving on to the next slide. So that concludes a very brief intro on how climate presents both risks and opportunities. In this next section, I'll hand over to Hannah, who will discuss the regulatory landscape and key industry initiatives. Over to you, Hannah, and as well, please, Hannah, introduce yourself briefly before you proceed with your presentation. Thank you.
Thanks, Hector. So thanks everyone for joining the call today. So I'm going to give a brief overview of the regulatory landscape and key initiatives that we're seeing across the UK and the EU at the moment. So I'm a senior consultant at BCS in the sustainable finance team, along with Joe and Hector. And primarily over the last couple of years, we've been looking a lot into TCFD. So in one of the later slides, we'll come back to TCFD and some of the key findings that we've had from our overview report that we've carried out this year. Great. So as Hector mentioned, in recent years, there's been an acceleration in a number of policy and regulatory measures designed to promote green and sustainable finance. Since the first Conference of Parties, or COP, in 1995, climate change has become an increasing global priority. In 2015, COP21 marked a significant milestone with the Paris Agreement being adopted. Every country agreed to work together to limit global warming to 2 degrees, or ideally 1.5, as well as to mitigate and adapt to the impacts of a changing climate and mobilise finance to deliver these aims. Additionally, every 5 years, each country is to submit a national plan for how they would reduce emissions. COP26 will be held in Glasgow this November, and after being delayed for a year, this summit will be the first time for countries to bring forward their updated plans and will be incredibly important in going further to help limit global warming to 1.5 degrees and avoid irreversible damage. Next slide, please. Okay, so as you can see, the growth in policy and regulatory measures has mostly occurred following the UN Paris Agreement and also the Sustainable Development Goals, which came into force in 2015 as well. Interestingly, there's been a consistent trend for voluntary industry initiatives to be adopted by regulators and made mandatory. We've seen this most recently with TCFD and the Bank of England, where it's expected to become mandatory by 2022. Looking at the trends of these regulations, there's continued focus on increasing transparency of climate-related activities through disclosure and robust integration of ESG considerations throughout the product offerings of banks and asset managers. Establishing senior level oversight and identifying climate as a risk as well as an opportunity is also something that's coming through quite often. However, there's a wide view that many firms are not well prepared for the suitability requirements and customization expected by clients, and that an increased focus on data and quantitative analysis is required to support upcoming scenario testing methodologies. As you can see, there's a lot of ESG legislation coming up for both the UK and Europe over the next few years. So if we move on to the next slide, I'll go into some of these in a bit more detail. Great, so starting with the Bank of England climate stress test. This is upcoming for 2021 and aims to test the resilience of current business models of the largest banks and insurers in the financial system for the physical and transition risks from climate change over a 30-year horizon, which is quite a long time in comparison to recent scenario testing or current scenario testing, and across 3 different climate policy scenarios. So that's early action, where the transition to a net zero economy starts in 2021. Late action, where this transition is delayed until 2031, and no additional actions, which explores the physical risks from climate change in a disorderly scenario. So the difference between the early action and late action scenarios also emphasises the point where this next decade is really considered very important in terms of climate mitigation activities and really focusing on reducing emissions and therefore the global warming temperature rise. So the next section that we have on this slide is the PRA SS319 supervisory statement. which expects firms to address the financial risks from climate change through their existing risk management frameworks, and also to consider disclosing how climate-related financial risks are integrated into their governance and risk management processes. The EU Taxonomy for Sustainable Activities, and in a couple of years, the UK Green Taxonomy, will introduce a consistent classification system for economic activity. This will allow greater transparency and comparison of the climate impact of investments to help tackle greenwashing. Next up on the screen, we have the EU sustainability related disclosures in the financial services sector. So this regulation has a confirmed implementation date of the 10th of March 2021 and will present a significant disclosure challenge. At a high level, this will require disclosure of how firms assess and evaluate sustainability risk across all product and service offerings, with publication of specific policies on websites and inclusion in pre-contractual statements. For products with ESG objectives or characteristics, there are also additional requirements to disclose the benchmarks used and how they work, as well as ongoing reporting and performance against sustainability criteria. Additional amendments to existing regulations, such as MiFID, which is on the far right-hand side of the screen, ensures full integration of client sustainability preferences into suitability assessments and enhancements to overall sustainability risk management. Consultations have closed on these amendments, and while there are key themes across these items, the variance of product offerings affected by these regulations will make it complex to implement. And finally, as I previously mentioned, the Task Force on Climate-Related Financial Disclosures, or TCFD, is likely to become mandatory as signposted by both the FCA and the PRA, but I'll come back to this later in the presentation. I'll now hand over to Joe to cover the road to net zero.
Thanks, Hannah. Great to see so many people on the call today. I'm Joe Lovett. I'm a senior consultant at BCS Consulting, and it's great to be able to discuss something which is so interesting. It feels like we're really reaching a tipping point with regards to the path to net zero with the upcoming COP26 summit in Glasgow. So without further ado, I'm going to discuss a bit more about the road to net zero. It's clear that investors and regulators are increasingly aware of the risks of climate change. The recent IPCC report in the run-up to COP26 has increased the pace at which firms are looking to navigate these risks. Most of you will be aware that the IPCC report recently scientifically validated that essentially climate change is real and global warming is only going one way, and that it's driven by human impacts. So companies and investors have a really big role to play in the road to net zero by establishing strong emissions reductions targets and robust strategies for reducing the risks from climate impacts. So I'm going to take a little look into what this means in practice, starting with essentially what is net zero, because net zero is something that's become a bit of a buzzword used in marketing materials and in the media, that's often used interchangeably with carbon neutrality. Carbon neutral is a process of offsetting your emissions by investing in carbon reduction initiatives, such as renewable energy projects. However, this doesn't really look at the bigger picture. So the need to actually reduce overall greenhouse gas emissions. So you can actually still increase your emissions and still be able to claim carbon neutrality. Whereas with net zero, the overall reduction of greenhouse gas emissions is the target, with the goal of balancing the emissions produced and the emissions removed from the Earth's atmosphere. So how do financial companies generate greenhouse gas emissions? Well, this can be segmented into different layers of scope. So scope 1 emissions are the direct emissions from controlled sources. So this is usually associated with a company's own operations. So for example, if they had a fleet of company vehicles producing CO2. Scope 2 are indirect emissions from energy which has been generated on a company's behalf, which is then purchased from suppliers and eventually used by a company. Scope 3 is indirect emissions that come from a company's activity in its value chain that are not directly controlled. So this is really interesting and important for financial institutions. And it's significant because this includes the finance that they provide to companies around the world who may then go on to contribute substantial greenhouse gas emissions. Now, what will it take to reach net zero across the economy? Well, this is going to take a combination of efforts that need to come together across a myriad of sectors to achieve net zero. The obvious one is to change how we source energy, so moving away from fossil fuels. But there's also a big requirement to innovate across the economy. So, for example, with our capabilities to absorb greenhouse gases and to stop its release into the atmosphere. But that said, at the same time, you can't just sit back and hope that the scientists and engineers will save us. It's up to the incumbents to actually reduce emissions. And there is hope that both consumer behaviour and government policy will ultimately drive this action across the economy. So how can firms achieve net zero financed emissions? So these scope 3 emissions that we were talking about. Well, financial firms have a huge role to play, as ultimately they make the key decisions on the flow of capital throughout the wider economy. Strong leadership is going to be required among banks, insurers, and asset managers to pull capital away from activities that are not consistent with the common path to net zero. So, for example, with fossil fuel energy companies and perhaps car manufacturers who are not moving towards an all-electric fleet, and then channeling this capital into climate positive solutions. So, moving on to the next slide, we're going to take a bit more of a deep dive into net zero in the context of financial services. So, one thing everyone can agree on is that the transition to net zero will be very, very expensive. So it's recently been estimated that about $130 trillion of investment will be required to reach net zero. And financial firms sit at the forefront of both the distribution of this capital and also the facilitation of the step change that actually comes with it. So let's consider some of the main challenges that are facing the financial services. Firstly, there's measurement capabilities. So a big part of this is being able to identify and measure exactly where this capital is flowing, and then benchmarking this against industry standards that will help the economy to reach its net zero targets. Because of the indirect nature of financed emissions, so those scope 3 emissions I was previously talking about, it is particularly difficult to give investors accurate MI for the emissions which are indirectly caused by, say, the capital allocation from a bank in the form of loans or from asset managers. Target setting. So target setting in the path to net zero looks far beyond the traditional sort of 3 to 5 year time horizons we're used to seeing when firms prepare their future business models. Here we're looking 10 years ahead at least in all climate related scenarios, which need to hit greenhouse gas emissions targets while stress testing the different climate risks that will materialize across a range of global temperature increases. And then obviously adjusting targets accordingly depending on how progress with the transition to net zero is going among the wider economy. Similarly, the transition plan, so the strategic transition for financial institutions, will need to be carefully thought through to align with net zero targets while ensuring both shareholders and stakeholders remain happy. This is rightly being pushed as a positive global agenda. So some of the examples that we've got here include essentially focusing on reducing exposure to climate risks and supporting sustainable development. But also planning for such a fundamental shift is really difficult, and this will constantly be evolving depending on the progress made in the transition to net zero. So for example, if the transition was too late and therefore disorderly, then that could potentially strike an imbalance between shareholder and stakeholder benefits. And then finally, all eyes will obviously be on the financial sector to make transparent disclosures to ensure that investors and governments are aware of progress and actually putting these strategic goals into action. So as Hannah mentioned previously, programs such as TCFD are going to become mandatory, and the hope is that this will enable standardization of reporting across the sector. So on the next slide, we won't go through each of these as we're a bit pushed for time today, but what we're looking to illustrate here is that there are plenty of industry initiatives that are emerging to support the net zero transition while addressing some of the challenges that I've highlighted in the previous slide. Some interesting initiatives to call out are the alliances that are being driven by the UN in the run-up to COP26. This has become increasingly important and gathered momentum for banks, asset managers, and insurers. And what this calls out are key industry players who are essentially joining forces to help to move the global economy towards net zero, with the goal of striking that balance between keeping shareholders happy, but also ultimately the stakeholders who are ultimately impacted by business decisions in relation to climate. So individuals such as Mark Carney and John Kerry are keen to ensure that there's a systemic approach to the road to net zero in the run-up to COP26. And that's why there's a really big focus on these UN alliances that are bringing together key players in the industry and essentially the largest players in the global economy to support us in our wider transition to net zero. Okay, so we're now going to move on to discussing what BCS have done in the arena of climate disclosures in relation to TCFD. So I'm going to hand back over to Hannah now to give a brief overview of that.
Thanks, Joe. So as Joe just mentioned, the TCFD report has become the leading framework for climate disclosures and will be becoming mandatory in the UK and in other countries across the world. So the TCFD released its final recommendations in June of 2017, and since that time has been adopted by many organisations across the world, including banks and asset managers, but not limited to them. The framework operates across 4 pillars that represent the core elements of an organisation's operating model, as you can see on the screen, and aims to provide more standardisation on the disclosure of costs, opportunities and risks associated with climate change for organisations across the world. While the TCFD framework includes some complex concepts such as scenario analysis, there's no minimum requirements of climate risk capability to enable disclosure. Many firms will disclose overall approach and forward-looking statements initially and progress the maturity of their disclosure in subsequent submissions. And this is something that we've seen through our second annual global progress report, with disclosures that had disclosed last year increasing up the scale of maturity this year. So overall, the report that we've produced includes an assessment of industry coverage. So where are the disclosures in the banking sector and what the relevant size of those banks and financial institutions are. And then also a maturity assessment of the disclosures that they're producing. So these have come from either the annual reports or the ESG reports or other areas that specifically identify them as TCFD reports. And then in the appendix of the report, we've pulled out some of the key best practice that we've seen across the industry. If you want to read the report in more detail, it's linked in this slide deck itself, but otherwise you can find it on our LinkedIn page. And there's some various blogs that we've produced to support this document as well, because it goes into quite a lot of detail. So if you're short of time, the executive summary and the supporting blogs are really useful. But just as a high-level statement, so we've been seeing that the TCFD engagement does show some sign of its stagnation, and that there is more action required to increase endorsement of the framework by targeting regions beyond Europe. So we see Europe as the leader at the moment in TCFD framework information. So there's definite area in terms of engaging banks and also increasing the level of maturity in those disclosure statements as well. But I'll leave us there and hand back over to Hector to give a quick wrap up before we move on to Q&A.
Thanks, Anna. So moving to the next slide, we're just going to present some of the key takeaways of what we discussed today. Clearly, climate is a very important source of risk now for the financial sector, but it's not just a risk, it's also an opportunity for innovation and to support the transition to the net zero. Achieving net zero will require drastic changes in society, and the financial sector can play a key role in reallocating capital to support this transition. The regulatory landscape is quickly evolving to accelerate the transition to a low carbon economy, and there's an increased focus in accountability and transparency. In relation to our research on climate disclosures and TCFD, Europe is clearly leading TCFD implementation. The most advanced areas of disclosures are banks' own environmental footprint and governance arrangements, whereas scenario analysis, impact on strategy, and metrics for climate risk management are the least mature. As Hannah said, there are some signs of stagnation on TCFD, so more action is required to increase endorsement of the framework beyond Europe. And there is also significant potential to grow coverage of the framework by engaging the largest banks, especially those headquartered in Asia, because there are plenty of large Asian banks that are not yet disclosing on TCFD. So I think that completes our presentation. happy to take on any questions that you might have.
Fantastic. That was absolutely fascinating, guys. Now, we have actually got a host of questions from our audience, but I'm going to take chairman's privilege and bowl you an easy one to start with. As you mentioned, COP26 is coming up at the end of the month. Can I ask each of you for one concrete thing that you would like to see come out of the process? Hector, do you want to start?
Yeah, I'm happy to start. Well, I think I'd probably start with the phase out of coal burning. We've talked about kind of eliminating coal burning for a long time, and there are some commitments, but there are still plenty of gaps. If you look at commitments across the world, there are always exceptions. Oh, we won't do any coal burning here, but we might do it there. I'd really like to see a formal global commitment to phase out coal burning across the world. And if there are going to be exceptions, to make sure that they are very clear and tangible and that there is no gray area.
Hannah, how about you?
So I've got a couple. I'll pick one. So personally, I think the actual commitment to reach some of those financial requirements is really important. I think we've got approximately 150 trillion financial investment that's required in order to meet the net zero goals by 2050. That's both from private sector side and increasing engagement from those aspects, but then also the funding requirements that are needed still from developing countries. But we've also done some work on the Sustainable Development Goals, and you can see that even the funding gap in those instances are very weighted towards the developing countries. So there's a big requirement in order for both public sector and private sector to engage in this and support the funding gap from both a developing and developed perspective as well.
How about you, Joe? What's on your wish list?
I'd personally like to see some really strong leadership from the US in the post-Trump era. So since President Biden's been incumbent, John Kerry's been pushing the agenda for the US as the presidential envoy for climate, and I'd just like to see that turned into some real tangible leadership from the US, both from a regulatory standpoint and also with the alliances that I mentioned in my slides into net zero, in terms of how they're bringing some of these key financial services industry players with them, signing them up to these things and essentially being leaders in the global transition to net zero.
Here. But of course, words and action are two totally separate things. And as we saw at both Kyoto and Paris, the US agreed to sign up and then couldn't get it through the Senate. So let's hope things stay on Joe Biden's side. Now, as I said, lots and lots of questions. Now let's start with the first one. The flip side to risk is opportunity. During the transition to the net zero period, what tips would you give to asset managers to remain agile in their approach to environmental investments?
I'm happy. Am I muted or? Yeah, I'm unmuted.
No, you're unmuted. Don't worry.
Because I had a message pop up and I thought, oh, I'm muted now. No, it's actually just saying I'm unmuted. No, I think in terms of the asset management, I think the investment on capabilities is critical. So when you look at the current maturity of the capability to assess the environmental impact of corporations across the world or businesses across the world, is still fairly limited. Most asset managers, for example, are relying on a lot of external third parties for their ratings, for their scores, for their data. And there is often limited expertise internally and a lot of trust being placed on the scores or the analysis that is done outside the organization. So I think in terms of stepping up and differentiating from the crowd, really setting your own internal capabilities and bringing people with deep expertise will be critical to have a very cohesive strategy in terms of how you engage, what is your appetite, what are the sorts of funds that you will consider ESG or net zero related, etc. And I also recommend a lot of focus on the emerging regulations. So for example, the EU taxonomy is setting quite prescriptive standards in terms of what is an environmental objective, what is a sustainable activity. Definitely very important to invest in data and to invest in expertise to support that.
Excellent. Now I've got a controversial one here. You didn't actually mention stranded assets in your presentation. Is there anything you'd like to say about the issue of stranded assets?
Yeah, it's a good one. It's true. I didn't mention this one, but I think that's definitely something that will be required. I think there's always this conflict that, to some extent, supporting net zero and achieving environmental goals undeniably might have some economic impact, at least in certain sectors, at least in certain activities. And we tend to try to avoid that at all costs. We tend to try to just focus on the things that are the low-hanging fruits and the things that don't have any knock-on impact on growth. But the reality is that whilst we might protect short-term growth by ignoring divestment, in the long run, we're just going to have a much greater economic contraction anyway if we don't address that. So I think divestment is very important, particularly in oil and gas, in the fossil fuel side. It will be required, and I think environmental regulation should push in that direction. I don't see how we're going to end up achieving net zero if we don't have any real plan in regards to divestment and to limiting activities in such areas.
And just to add to that, I think it just highlights the importance of taking action now to limit the impacts of a potentially disorderly transition later down the line. To make that transition as smooth as possible requires action now, and I think that's one of the key things we want to see coming out of COP26.
Now, I have got several questions here which are asking about how we can smooth the pathway to a low carbon future. At the end of the day, we need to maintain our infrastructure now. If we're divesting from fossil fuels, how do we ensure that a minimum amount of investment goes into those sectors to stop it, existing infrastructure that we rely on falling apart? I think people have probably got a thought about the UK's petrol crisis and the issues they're having with energy shortages in China. So how do we keep the lights on while we're transitioning?
I think it's a gradual process, right? Even the environmental commitments are not trying to expect that by 2022 the entire world has shifted to renewable energies. I think the plan is to transition gradually, and there is obviously awareness that we are locked into this grid. We cannot change from one day to the next. And the Paris Agreement goals and targets are considering that gradual transition. So you're trying to balance out minimizing the systemic impact of cutting ties to such activity too quickly, with moving fast enough to avoid devastating effects if you don't. So I think you have to keep a balance. I think the markets also balance themselves out. So although you might divest capital, if the price drops too quickly, the market is fairly efficient, will react, but will rechannel back in. So I'm not too worried of this argument that divestment will create like an economic crisis because all the capital will be pulled away. I don't think that will happen. I think it will be a gradual process, and by doing that gradually, you actually avoid a sudden quick shift. Too quick, that might be a major source of financial instability in the future.
I think that's an excellent point.
I think with that as well, that it just shows the importance of investment in scientific developments as well, because there's definitely some research ongoing about using that existing infrastructure and developing it into that forward framework and activities that are supporting the transition to net zero as well. So keeping the eye on the end goal whilst making use of what you've got. So recycling at the end of the day.
Excellent.
I also think there's quite an interesting point there on the role that insurers have to play as well, and not just looking at other sectors and divestment, but also incentivization and disincentivizing with the use of insurance products. I think that could play a role in making it as smooth and as gradual as possible.
Absolutely. And as you know, Joe, there is an insurance industry organization called ClimateWise who are doing some excellent work in this area. But unfortunately, getting insurers to work together is like herding cats. So, perhaps we will see more collective action in the future. Now, I've got an interesting question here about something that you mentioned, Hannah, which is the UK green taxonomy, which is in the pipeline. To sum up the question is why are we bothering doing this? The EU taxonomy seems to be getting global domination at the moment. Is there any point in the UK creating its own taxonomy, or should we be getting in line with Europe?
I think quite often, even with the UK's own regulation, it is very much in line with the European anyway. That's we've seen this with some existing clients, whether they want to keep on with the European regulation or wait until what's coming out of the UK as well. So I think it's every little helps, really.
This is a really good one, because a lot of our clients are quite concerned with the EU taxonomy and the announcement of the UK of their own taxonomy. So many of our clients have said to us, well, what if the US comes up with their own US taxonomy, and then
and I'm sure they will.
and so this might become something where you need to report for every jurisdiction a slightly different classification. So I hope common sense will prevail and that there will be alignment. I think the UK, from what I've heard from clients that have had engagement with people that are directly involved in the taxonomy, the UK is concerned that the EU taxonomy might be too technical, too cumbersome, too difficult to apply, and there might be an opportunity to do something perhaps a little bit simpler. As there's typically the UK regulations are more principle-based, less prescriptive than the Europeans, and there's that view that the UK green taxonomy might be perhaps simpler. But we are obviously all quite concerned of the implications of having multiple taxonomies, which would be a real nightmare from a reporting perspective.
Absolutely.
Somewhere where this is acutely felt will be Hong Kong. So they're sort of at that gateway between mainland China, who have their own taxonomy in the West, and it's going to be really interesting for our colleagues in that part of the world to see how they work with these different types of taxonomies and hopefully try and push something towards a bit more balance.
Now, you mentioned risks during your presentation, and they were really focused at the corporate level. Do you think that sovereign risk is going to become increasingly important?
I think so, and I think I certainly saw, we had just last week, funny enough, I had a conversation with a number of our clients that are quite concerned with sovereign risk, and in particular with the fact that the EU taxonomy doesn't have very good much consideration or sufficient consideration of taxonomy risk when looking at the overall framework. I think that's certainly going to be increasingly an important area. Undeniably, certain countries will be more exposed to climate than others. And the economic development plays a good part as well. The more developed you are as an economy, the more likely you are to move regulation quickly, so you're more pushing transition risk. And on the other hand, if you're a developing country, probably you will be moving slower on the regulatory side, with exceptions, of course, but as a general trend. But you will be more exposed possibly on the physical side. You will have lower capabilities, most likely to remediate. So it's definitely something that is concerning and needs to be looked at properly. And I think there's still plenty of work to come in that space.
Fantastic. Now, thank you so much for your time today and for a fascinating presentation. We've still got a host of questions from our audience that unfortunately we're not going to have time to cover. I will pass them on to our speakers, and I'm sure they'll be able to contact you directly to answer them. Chaps, thank you so much for your time. It really has flown, and unfortunately we've got to say farewell. There's just time to thank our sponsors once again and to remind you of some of our forthcoming FS Club events. On the 11th of October, you can hear about innovative tax techniques for employee share schemes. On the 13th of October, there will be a fascinating chat about AI, looking at practical examples on the cutting edge of natural language processing. And on the 20th of October, please put a marker in your diaries for the launch of the 8th Global Green Finance Index. Details of these and lots more are on our website. Ladies and gentlemen, thank you so much for your time, and I hope that we will see you again.